September's off to a strong start. Joining us is John Kingston, Director of News at Platts, and Jay Taylor, President of Taylor Hard Money Advisors from the CME, Bob Chino of TraderInstinct.com. John, we usually talk to you about oil. Can you explain why we're almost $100? Are we truly well supplied globally and demand is weak? Then why are we at 100?
We're well supplied with crude, but we're not well supplied with products. And as a result, what they call crack spreads are just unbelievable. They're off the charts.
Well, that's for gas. Why is oil at 100?
Okay, no, because at a certain point, and it's not just gasoline, it's also distillates like diesel. At a certain point, if those markets go up, they'll drag crude along with it. And that is absolutely what is happening right now.
I could overlay a gold chart over that crude chart right there, and it's the same. And that's right when we started talking about QE3 was in June.
Okay, fine. But at the same time, if you also overlaid products, they would have gone up a lot further.
Right. So it's not QE3? It's supply and demand?
I didn't say that wasn't a factor here, but you've got to look at the products markets dragging up crude. There's no doubt about that's happening. Now, the one thing is there's a lot of refining capacity that was knocked off during Isaac. Isaac had a lot more impact than I would have said 2 weeks ago. That refining capacity is going to come on, and every refiner is going to want to buy crude to run it because the margins are so great. So that could actually boost crude further, but at the same time take a little bit of the air out of this products balloon, which is clearly a major factor in the market right now.
But so you can actually connect for me dots between when refining gets expensive and you get a crack spread that goes up. You can somehow trace that back to oil going. Does that make sense?
Yeah, markets are funny. Crude can lead. It can be economic factors, and it can. But products can lead.
Everything leads higher. I mean, and the OPEC laughs. That's not fair.
But
I would not logical.
Okay, but I would say this: that right now, because of the fact that margins are so good, you are probably going to get a little pricking of this balloon of the products market because everybody's going to rush to make product right now because the margins are so fantastic. And I think you're going to find that those inventories, which are right now very tight, are going to build somewhat.
What do you think, Jay?
Yeah, I think there's, it's a big question in my mind, and I don't follow the oil markets as much as I do the gold markets, but there's no question that there's some QE in here and there's some speculation into these commodity markets in general. I mean, you see the response after the announcements, the anticipation of another QE drives these things. So, I mean, I don't follow the oil markets like this gentleman, but
yeah, well, okay, let's talk gold then. Just switch. Dalio was pretty smart. Said I can't see any reason why someone wouldn't at least own some gold at this point with what's happening with central banks.
Einhorn, same game. I mean, there's so many of these guys that are out there saying that.
Well, absolutely. I mean, look at what's happening with the Basel III Accord. Their proposal is to make gold even with treasuries and cash as a reserve asset. And in fact, a lot of the European banks, from what I understand, are actually selling their gold and buying treasuries because treasury gold has got a 50% haircut. So they're buying treasuries to bolster their capital accounts. And that's what I think the biggest problem we have now is that we're facing a global deflation, credit deflation, that has to, one way or another, whether we QE or not, the debt to GDP ratios around the world have to come down to more normal levels, and I think that's what Bernanke is fighting. I think he's right to be scared about deflation. I don't see the inflation just yet, but you see it here in the commodity markets from time to time. But until you start getting people spending, until you start to get the velocity of money going, the banks are flush with cash. They're not lending. This is very much like the 1930s, I believe. And I think the policies are very much like the 1930s. It's just more so. It didn't work in the 30s. We didn't question it. We never questioned whether the policies were right in the 30s. It was just that it wasn't perfected. It wasn't enough of it. So this time we're going to find out. Bernanke is going to really put this thing to a test, and he is. And QE infinite now we're seeing, and God help us, because I think what all it does is increases the debt to GDP ratio, which is far greater now than it was at the bottom of the Depression, 1932. Was total debt. I'm not talking government debt, but total debt was something like 285%. It got up to 325 or so now. It's come back a little bit after Lehman Brothers. We've seen a little bit of deleveraging, but if you look at the historical debt to GDP, we're way out of whack. And so that is bullish for gold, believe it or not. Most people look at gold as if, oh, you just want to own it for inflation. But the real price of gold does extremely well during deflationary periods of time. The 1930s is a good example of that.
Bob, how much do we see equity markets benefit? We got our bang for our buck already, or is this going to be a slow, steady move higher as the $40 billion a month comes into the market?
Well, I love the use of QE infinite. We've heard that. Everyone believes it. It's a very, very accurate term, in my opinion, and I think that leaves a little bit more room to the upside on equities. However, equities don't go up in a straight line, they go down in a straight line. And so as you look at the sort of risk-reward metric, the risk-adjusted returns of the equity markets, it continues to get a little out of whack at these levels. Even if right now you're looking maybe downside about 1350, upside the all-time highs. That's about a 1-to-1. But then once you get up to those all-time highs, you get a weekly close above them. The target's about 1800 in the S&P, but the downside now extends to about 1100, and the risk-reward gets completely out of whack. It gets well above 1-to-1. So I'm still bullish equities, but I do have my finger on the sell button, and I think a lot of people are of that. As the time that people hold these trades in the equity markets, their duration shortens, you got to be nervous about sort of the risk-adjusted returns in equities. Having said that, still bullish U.S. equities.
1800, I'm above 30% for the year. I hit my number. That's what he just said. So I'm going to get that eventually, right, Bob? I was right.
It's an extension of the retracement. It's a logical target if we get a weekly close above the all-time highs. But employment's not growing. It's just the stock market rallying. That's it.
All right, gentlemen. Thank you. Thanks, Bob.
Thank you.
And John and Jay. I'm going to keep everyone straight. And